All right, y'all. Next up, we have the CEO of Sundial Growers, NASDAQ-listed SNDL, Zachary George, moderated by a great gentleman, Scott Greiper, president and founder of Viridian Capital Advisors. Scott and Zach, make your way to the stage, gentlemen. Give them a warm round of applause.
Sure. Yeah, this works.
Is this on? Yes. Hello, everybody. Next victim on stage is Zach George, who is the CEO of Sundial Growers. My name is Scott Greiper. I'm the president of Viridian Capital Advisors. First of all, I want to thank behind the curtain Patrick and Elliot Lane, Javi Haas, for putting on another unbelievable event. So Sundial, for those of you who've been following the company, one of the largest players up in the Canadian market, has undergone an incredible transition in the last couple of years since Mr. George has come on as CEO. Some of that has been organic change. A lot of that has been M&A change. So I'm going to get into how he's pursued, what he's pursued, and why it's led to such a significant increase in the market value of the company and the financial performance. Today, about an hour ago, we released our weekly Viridian Cannabis deal tracker. Hopefully you guys are all subscribers to that. And once again, we're seeing a decline in capital coming into the industry, but we're not seeing any decline in M&A transactions. The last year and a half has been a record year for the number of M&A transactions in this industry. We continue to consolidate, and Zach has been a major player in using that M&A to improve his business. So first of all, Zach, nice to interview you today.
Thanks, Scott. Great to be here.
So you came in 2 years ago as CEO. You've made significant operational changes, strategic changes, M&A changes. What did you see at the company when you arrived that led you down this path to making these changes?
Sure. So when I arrived and I started as CEO in early 2020, the company was experiencing extreme challenges. So we had cost control issues, we had excess leverage, we had challenges with cultivation, and we lacked focus. So we were trying to pursue initiatives in wellness, recreational, and medical cannabis all at the same time. We had initiatives and we're spending money in internationally in half a dozen countries. And we had a very difficult situation where effectively within 6 months of our August 19 IPO, we had our equity value virtually cut in half. We were in breach of all of our bank covenants, and we were about to miss payroll. So significant restructuring was required. We ended up letting go hundreds of employees, and it was clear from the early days that we were going to require an in-court or out-of-court restructuring. So by middle of 2020, we had orchestrated that restructuring through a combination of asset sales, debt for equity swaps, and some pretty ugly rescue financing. And thereafter, we were the subject of very intense social media focus, which enabled us to raise significant capital, which over about an 8-month period, we were able to raise just over $1.2 billion.
So I don't know if you guys trade or follow Sundial stock, but the volume, the average daily dollar volume of the stock is just incredible. Probably the top 5 or 10 most liquid names in the cannabis public markets, which is not an easy thing to achieve since most of the stocks have been in decline. How did you get there?
So it's not a dynamic or something that we courted or sought after. It's really something that happened to Sundial. And the way I would explain it is that what we saw through COVID was really the rise of the stimulus-funded work from home, Robinhood account holding, day trading retail investor. And their support and activity was instrumental in enabling us to shape the business to where we are today.
So when public companies raise money in a PIPE transaction or a secondary, the underlying liquidity is critical to the investment.
Yeah.
So I have to believe that your level of liquidity has helped you improve your cost of capital when you're raising money?
Yeah, that's right. But we're also, we haven't raised capital in quite some time. So we're really looking to earn the right to take additional risk and prove out the development of our business model at this point.
Okay. The market has been a little pessimistic about your inability to file your fourth quarter results from last year in your annual report.
Yeah.
What do you expect, and when do you expect that to happen?
Yeah, so we expect to file our full year financials for 2021 by the end of the month. And I just want to be clear, and I take responsibility for this delay, but just want to be clear that this does not have anything to do with a dispute with auditors, with restatements, or with revenue recognition. This is really a function of a rapid pace of growth for the company. And that pace of growth has put both our auditors and our finance team under a significant amount of stress. So to solve this, we're making investments in our finance capabilities. But you also have to keep in mind, over the last 2 years, at the lows, our market cap was less than $30 million US, and at the highs, greater than $3 billion. So we've really been able to transform the business at a very rapid clip, and that's really what's been driving this delay.
So you've done a lot of M&A transactions, both on divestiture and acquisition, and that's challenging for any accounting firm to try to get up to speed and file on time. So I think there's some rationale to that. Zach, when you look at your business, you have to be one of the most uniquely diversified companies in the public cannabis sector. You have your cannabis operations, large vertically integrated operation up in Canada. You acquired one of the largest liquor distribution companies in North America and the largest in Canada. And then you stood up a finance arm, an investment arm, which is driving a lot of your profitability. I'm not quite sure there's any other public cannabis company that has that mix of assets. This is a capital challenge starved industry right now. And you've lent out and invested and provided financing, I don't know, about $500 million so far. How did that start? And how big a part of your operation is that finance arm?
Sure. And the order is actually reversed. So we started our finance arm prior to the Alcanna acquisition. But it's really a function of the overall strategy for the business, which we developed as soon as we were able to lift our heads up and take a deep breath and look at what was happening in the industry, and really asked ourselves, where do we see economic returns that are being generated in the cannabis sector? And as everybody knows, the Canadian operating environment is very challenged right now. You've got a combination of oversupply, excess licenses, too many stores, regulatory dysfunction at the margin. So there needs to be a lot of change. I think we're in the third inning of a distress cycle in Canada. But what we saw were two sort of main conclusions. The first, when you look at US markets that are more mature, you see a strong correlation between the SKU count at retail, the permissible levels of vertical integration and profitability. And then the second conclusion was that in this supposed gold rush, it's really not the gold nor the pickaxe and shovels, which is where real economics have been earned. And so it's the financing of those activities where the lion's share of economics has been earned thus far. So elevated spreads driven by the fact that you don't have bank participation, unique instruments like convertible debt with ratchet features, unit warrant transactions. There's been a significant amount of value created for investors through those instruments, while many companies themselves are struggling. So we set out to build a model that could take advantage of the benefits of vertical integration in a modified way, because the regulations in Canada are at the margin problematic. And the second pillar that we built out was really focused on taking advantage of our liquidity, our access to capital, and being able to, in a compliant manner, deploy capital into the US. And so we've built out about a $500 million Canadian credit portfolio on the back of that.
You still have about $500 million in cash on the balance sheet. How is that generally getting correlated to organic growth and supporting the vertically integrated operation versus the investment arm and lending and providing credit to other cannabis companies?
So in terms of our aggregate business, we're laser focused on getting to a position within this calendar year where we're generating positive free cash flow. And if you compare that to some of the experiences with other Canadian LPs, it's a pretty stark difference. Many of our large peers and competitors are burning anywhere from 30 to upwards of north of $100 million a quarter. And we just can't accept that type of capital destruction. So while the core cannabis business is still struggling, we've been able to bolt on a large portfolio of liquor and wine stores, which is going to stabilize that cash flow, in addition to the margin-rich interest income we're generating through the loan book.
So you acquired Alcana, which is this large liquor distribution business.
Yeah.
And I think we've seen for the prior 5 years displacement of alcohol use to cannabis use. But I've not seen, not saying it didn't happen, any other cannabis company that's actually bought in the liquor and spirits world, because they're somewhat competitive to the consumer now. So what was the rationale behind that, and how is that working?
Yeah, so this is a regulated products opportunity. So many of the same skill sets, when you think about the experience at retail, how you face consumers, there are many analogs. But this situation presented itself in a manner that was highly strategic to us, not just because of the stabilized cash flows that come from the liquor business, but also because Alcana held a 63% interest in another Canadian public company called Nova. And so that overall acquisition has put us in a position where we're actually the largest private sector distributor of alcohol in Canada, with 170 retail locations, and also the largest distributor of cannabis with over 180 individual locations. Now, as most would know who follow Canada, the sort of average revenue per location is much, much lower than what you'll see in a lot of US jurisdictions. But it's a large portfolio nonetheless.
So you had zero or relatively zero physical dispensary locations a couple of years ago, and now you're at around 180. We've seen in the US some disintermediation of the vertically integrated operators, some getting out of the growth side and focusing on retail because that's where the brands are sold, that's where the consumer is. We've seen groups only going to roll up retail and not wanting to own, grow, or process. You went to vertically integrate, partially through acquisition. What's the vision behind that?
So this is going to evolve over time. And I think greater specialization and focus is going to come across all these models as best CPG practices are implemented in the cannabis sector. But right now, by and large, it's really the vertically integrated models in mature US markets that are generating the highest levels of profitability. And so that's where we're trying to start. And with our influence or control over multiple public entities, we're going to have the ability to refine that model over time to bring more specialization and focus to those activities.
What is the economic benefit to the company from vertical integration? What does it bring you?
It really brings us access to the consumer. We really want to own that consumer relationship. And there's a tremendous amount of data that's accessible at the point of sale that is very attractive for us as we're looking to delight consumers and develop new products that will resonate with them.
The highest margin product at retail is the company-owned brand, right? Not the licensed in brands. What's your vision in building up company-owned brands that you could sell now in the stores that you've acquired?
Yeah, so we have 3 core brands already in cannabis. And we just initiated our very first private label initiative through our Spirit Leaf banner. And so that's a process that is ongoing. And again, what we're seeing is really the commoditization of branded retail product right now in Canada. And so you need to see a lot of change for this market to get healthier. You know, in many markets in Canada, you're able to buy ounces of flower for the same price you're paying for eighths in normal markets in the US.
And what's the perspective of, you know, we just went through the most severe price decline in California of the last 6 months, wholesale, retail, indoor, outdoor. And we're starting to see some stabilization.
Yeah.
There's many reasons behind that. Do you foresee that happening in Canada from a pricing perspective?
I think in many ways, Canada is ahead, right? So we're underwriting about a dozen companies in the US right now as potential borrowers. And we're seeing wholesale trade dry up in certain instances. We're seeing pricing and margin pressure that's very widespread. And so I would say, you know, we hate to say it, but a lot of states and a lot of US markets are going to have their own Canadian moment. And we've really seen a trend where about 3 years into legalization, these markets can get very overbuilt and saturated and come under massive pressure. So I think we're just about at the darkest days in Canada. We're going to see things evolve quite dramatically over the next 18 months.
Is that primarily consolidation, taking out the weak players, eliminating some competition?
It's consolidation, it's attrition, it's bloodshed, it's business failure, it's full contact capitalism.
So a major part of Viridian's practice is M&A. It's become the largest part of our practice. We talked about the M&A transactions. You've gone down the path to build out your retail presence, to buy the liquor distribution company. You said now that you're funding or financing or providing credit to 13 or so US operators. Is that correct? Is there an eventual M&A path for you guys in this country?
There may be. We're going to stick to our knitting for right now in terms of our strategies. And we're big believers that we need to earn the right to take risk. So to the extent that we're successful in the Canadian market, you know, we will certainly be emboldened to look at greater international opportunities. But we are really focused on Canada, and we believe Canada is a market that's worth fighting for.
So as a large Canadian player, I'm interested in your perspective on the US marketplace in terms of not regulation or legislation, but we're starting to see commoditization coming into the industry. And it's not just California, and it's not just Oregon, and it's not just Washington. We're seeing pricing pressures in some newly minted states, like Massachusetts, for example, Michigan. So you guys are a little further ahead in terms of experiencing that pricing pressure. I'm interested in your outlook for the US cannabis marketplace that's starting to go through what you guys up in Canada went through some years ago.
It's certainly a complex issue. But really to summarize, I mean, the American marketplace is subject to intense competition. And in many ways, the American market is better at capital formation. So as we've said many times, I think, you know, there's this notion that somehow, you know, federal legalization is going to be this massive boon for everyone. You're going to see the wrong management teams get funded. You're going to see more competition come in. You know, generally speaking, you know, trees don't grow to the sky, you know, is the saying, right? So I think you're going to see a very similar cycle emerge across these states with a healthier industry emerging on the back end.
So I want to get back to your acquisition of two liquor distribution companies, which positions you as the largest such distributor in North America. Is there eventually, do you see any overlap in Canada, one of the largest in North America? Do you see any overlap in the very long established distribution channel of liquor and cannabis? And is there ever going to be products sold in each sector's stores? at retail. Was that in your mind at all when you made these acquisitions? Or was it kind of a hedge?
I think that's a longer tailed opportunity. There's certainly a hedge aspect to this. We wanted to be able to build a dominant cannabis retail platform. With the Alcanna acquisition, we got an absolutely wonderful retail management team that's been in retail ops for more than 2 decades. So we really filled in some talent deficits that we had, on that side. I think the crossover, whether you're talking about co-location of liquor and cannabis retail, or crossover, products, beverages, for example, you may see those things happen over time, but it's a much longer tailed opportunity.
Okay. I see Elliot over there giving me the big hook. So, Zach, thank you very much. Sundial is publicly traded on NASDAQ, going through an incredible evolution. Thank you.
Thanks, Scott.
Thank you, gentlemen, very much. Amazing conversation. 2 amazing leaders in this cannabis industry, Scott Greiper, Zach George. Thanks again, gentlemen.